Welcome everyone. We are live streaming today here in Montreal with Mr. Jack Schwager. How's it going, Jack?
Oh, great. Thank you very much.
Wonderful. Pleasure to have you here. And I know some people will join us live. So if you guys are joining us live, comment in the chat. Let us know that you're watching this, and we'll make sure to answer your question anytime and make sure that we provide a lot of value for you guys. So we want to talk about a little bit of everything today. So trading stuff and how to trade for other people, which is something that Jack has built something really useful for. So we'll talk about that. But first, Jack, please give people a small introduction about what you do, what you've been doing in the past, and how that transitioned to what you do now.
Okay, I mean, very, very short thumbnail. Career-wise, my career started really in research on the derivative side. I'm working for major brokerage firms like Prudential, Payne Weber, and so forth. I was a director of research on futures, and that lasted for approximately 22 years. I spent 10 years subsequently as a hedge fund with a hedge fund advisory firm as a partner in that. So I have that side of the business, and all through my career, I've written books, as some people may know, most prominently the Market Wizards series. When I say most prominently, I mean most in terms of what most people will know about the Market Wizard books. I've also done analytical books, and in the last few years, I've been a partner in a new financial tech startup called Fundseeder, which I guess we'll talk about. And that's as short as I can make a long career.
Nice, wonderful. And I know a lot of people recognize you right away. So Anmal, who's joining us now, says you're a legend, which is awesome. And Basti, that's really good. Great. So I want to kind of maybe go a little bit back to, because a lot of people you talk about, and you probably talk about Market Wizard. That's like the thing the most well known for. So I want to, what was interesting the first interview was to talk about kind of how you wrote it and things you went through. I want to ask you maybe for a couple of maybe lessons you got from that book. And I know there's like a ton of them, but maybe if we can like pick one or two that people, or maybe that mark you the most.
Yeah, well, sure. I mean, there's a ton. I mean, that book and the other Market Wizard books that followed in subsequent years, they all have a lot of so-called lessons, and it's always what I wind up the book with is all kind of a summary of all the lessons. But I guess the one I try to emphasize most, because it's what people are most misguided about, particularly beginning traders, and that is most people are looking for something on a silver tray. Hey, teach me how to trade. I want to be a trader. Tell me exactly how to trade. Well, it doesn't really work that way. Well, for a number of reasons. But most importantly, all good traders find their own path, and it's not like there's one way to trade. There may be one way to trade for each person, but it's different. So people really have to discover their own way. You can learn from other traders, and in essence, the whole point of the Market Wizard books is you read those books and you learn from those traders that you can relate to. So you can certainly learn from those traders, but what you can't expect to get is somebody to give you a cookbook on this is exactly, you do A, B, C, D, E, and you're going to be making $1 million a year. That's not the way it works. You have to kind of find your own tools, what works for you, what you believe in. You can learn a lot of different lessons, but you still have to put it together yourself. So the most important thing is you've got to find your own path. Every successful trader I've ever interviewed found their own way. I don't think I've ever interviewed a trader that said, yeah, I really became a good trader is because I worked for Mr. X and he taught me everything. And, it's never been the case. They may have had people they learned from very important lessons, but they ultimately developed their own methodology.
Yeah, love that. And that's something I've noticed myself. Now, I just think people have always kind of the same step-by-step progression, or do they go through different kind of paths to become successful?
So the question being...
yeah, so do people like follow a step-by-step process? Like they do this and then they do this and they maybe fail a little bit and then become successful? Or they all have different steps that they go through?
Well, everybody has, by definition, everybody would have different steps. And even in traders don't always end up, you may start at one place and end up in a totally different place. And that's part of the evolution and progression of becoming a successful trader. um, you're not always going to figure it out right away. You may have to try a lot of different things until you finally evolve into some methodology that fits.
Hmm.
So the steps are going to be different for everybody by definition.
And they don't end up at the same place. You might think that you will trade, let's say, for yourself, but you end up trading for a big company or a bank, let's say, right? That's possible.
Well, yeah, I mean, that varies. I mean, people they could end up working for an institution, they end up trading for themselves, they end up running their own fund or something like that. So,
Yeah.
again, that's kind of depends on the person. There's no single pathway.
Yeah. Yeah. Love it. And I'm curious about, we've talked about this before when we first met and we first talked about in the first interview. What is the role of your trading in kind of your life? Because you've been trading a little bit. I know we've talked about kind of your style
Yeah,
in the past, but how do you see your role as a trader? And I know you're doing a lot of stuff on the side, so it
yeah.
might be hard to manage trading as well.
Well, I've always done a lot of stuff, and so to be clear, and I always tell people this, and people assume that my main endeavor is I'm a trader.
Yeah.
Not That's not true. In fact, trading sometimes I'm trading a lot, and sometimes I'm not trading at all. So trading for me is a sideline. It's like a hobby that I do occasionally when I'm in a mood, when I have the time. It's not my avocation. Um, my main I'm usually involved with one main day job, which, as I said, could have been being director of a research department at one point, or a partner in a hedge fund advisory firm at another point, or right now the research officer for a financial technology company. So whatever that is, that's usually the first. Or I should add to that, being an author. I mean, I have taken complete sabbaticals for a number of years of my life where I've just been writing books, but whatever. So when I'm writing books, that's my main endeavor. So but there's never been a time where my main endeavor has been trading. And there's a few reasons for that. One is I don't consider myself a good trader. I mean, not a good enough trader for it to be my main endeavor. So I've never considered myself such. So something that I've was interested in, liked, and find fascinating at but it has to be at the right time, and it has to be when you want to do it. In fact, there have been times where I've been trading, and I really didn't want to trade for any number of, well, because of the time commitment involved or whatever. And I found in the past when that's happened that I usually find a way to sabotage myself. If I really don't want to be trading, so now I'm smart enough, hopefully, that if I know I've got other things and trading is a strain or a distraction, or I don't have enough time to devote to it, I just won't trade. So it has to be where you want to do it. It can't be because it can't be an obligation, because it's an obligation that's not good.
Mm-hmm. And this can be quite tricky especially if you're a trader and you know that you have to trade. Not feeling that you have to trade and trying to push yourself to kind of not trade might be hard too. I know.
Well, that's
For
different.
me, it might be hard.
So in that situation, you're talking about somebody who maybe is trading for a living or
Yeah.
trading as their job. But I've never gone there because I didn't want to go there, and I didn't feel I was skilled enough to go there as a trader. So I've never been in that position. Now, if you're in that position, it's much more difficult. If you're earning a living as a trader, and it's a hard thing to do. You have to be really good to do that. But if you're doing that, then you don't. That becomes your main endeavor, and it's not a question of, well, do you feel like doing it or not? So you've chosen for that to be your main endeavor. But like I say, I personally have never gone that direction, and I consider myself more of an analyst and a writer. I've always considered myself more of an analyst and a writer than a trader. The trader has just been what I've written about, and it's sort of because it was so successful, I continue doing it. But that was never my main function.
Mm-hmm. That's interesting. And so we had a few people joining us. We have Scott, we have Anmal, and Griffin. If you guys are joining us live, come in the chat. Make sure you want to say hi and everything. We have a good question from Animal. I think this is especially related to what we talked about. Is it normal for traders to have some negative years of return in trading?
Well, even great traders have losing years. I mean, maybe some traders that have avoided it. I mean, yeah, not maybe. There are some traders I can think of. I can think of some traders I've interviewed who've never had a losing year, but that's really the exception. Even very successful traders have had losing years. The idea is the big thing is the losing year should be kept. You need to keep the losing year relatively small.
Yeah.
That's it's not so much having a losing year; it's that it not do really significant damage because of the way percentages work. I mean, if you have a 50% losing year, you need 100% to come back to make it back to even. So the idea you have to keep the drawdowns fairly shallow, and really successful traders they may have losing years, but they don't have giant losing years. That's really the difference.
Any thoughts on like how people should get back from losing years? Let's say you've lost in the year 10%. How do you get? What do you do to get back the next year?
Well, let's put it in context of not just the losing year, but just the losing period, because let's make it restricted to just a year.
Yeah.
Because the same lessons apply. So and that's the question is, how do you recover from a losing period? Well, first of all, lesson that you would get if you read the Market Wizard books, what will come across is the way really good traders react to losing periods is one of two ways. Either they stop trading completely at a point before the loss gets large, or they scale down their positions very, very dramatically, so the trading is not having much of an impact one way or the other. And whichever route they choose, they don't even begin trading or begin scaling up their trading until they feel they're getting back in the groove. So let's just take the simpler case. You're not doing well, and discretionary traders I should say, I'm talking here about discretionary traders because systematic traders, if you're a systematic trader, you either trade the system or you don't trade the system. So it's not that type of choice. But for a discretionary trader, almost every discretionary trader will hit periods where no matter what you're doing, it's just not working, just not right. And when you hit those type of periods, and when I give talks, I tell people you can't try harder to make it go right when it's not right. And the only thing you could really do is kind of pull away and stop and just clean the slate, and then go and take a vacation, take a break, whatever. And when you come back with a clean slate, and you begin following markets, and then you begin trading when you feel conviction on trades, and you begin small. And once you're profitable, you can build it up again. But that's a way to get out of this vicious cycle of where you're losing and losing begets losing, because once you make some wrong decisions, you'll start making second guessing yourself, making other wrong decisions. You have to break that cycle. And so that's what the best thing you can really do is to just get away with it and come back with a clean slate and start again conservatively. And that way you don't allow one period to drive you into a deep loss. Because way before you get to that point, and don't forget, you don't go from being at some profit to having a significant loss. You actually have to start giving up assuming you're at least ahead at some point, you have to start giving back your profit. So that point of stopping trading or scaling down can well occur while you're still up for the year. It could just happen while you're in a drawdown. Yeah. So it's important to know that if things are not going well and you just seem to be out of sync with the market, break that cycle by either, like I say, stopping trading altogether and coming back when you're ready, or scaling down to the point where it's not impacting your trading much, your equity much, I should say.
Mm-hmm. That's good advice. And I've just seen traders in the past who kind of completely changed strategies. Like they were trading one thing and then over time they trade something different.
Yeah, I mean, it happens. And sometimes that's the difference between success and failure. Like I can think of, well, maybe like most radical example I can think of is Marty Schwartz, who originally was trading stocks fundamentally and was continually losing, and then switched over to technical and did enormously well. It took him a while to figure out that what he was attuned to trading was technical, not fundamental. So it could be as radical as that, you complete change in methodology. And you have to, it's part of it, like I say, even for myself. I mean, I started out with fundamentals also, didn't work for me at all, and eventually went to technical, and actually went from chart-based to systematic, and then eventually ended up again to chart-based trading. Just, as I say, you have to kind of figure out what works for you. And there'll be reasons, there'll be obvious reasons. For example, fundamentals didn't work for me because I found that there was no way that I could figure out how to tie risk management with fundamentals, because if something was cheap and it got cheaper, then you'd, based on fundamentals, want to buy more. And that's kind of the antithesis of risk management. So I couldn't marry, for myself, I couldn't marry risk management with fundamentals. And technical kind of worked more naturally with risk management. So that's why I kind of, at one point way back, decided that fundamentals is not the way I'm going to trade. Although I may sometimes have a fundamental concept that drives my trading. For example, the best example I can think of is in late 2008, when everything was collapsing. I felt commodities and emerging markets had gotten just ridiculously oversold. I didn't know the intrinsic fundamentals carefully, but just from value, from where they had been long-term historical to where they were at that point. So that kind of drove my trading from the long side and without the money calls, and it did drive the way I was trading. But still, the trades themselves were technically oriented in terms of picking entries and exits and stuff like that.
Mm-hmm. And I kind of like this idea that there's no wrong way to do things. Everybody has its own way, and that's what they act on, and they usually succeed with the right thing for them.
Right.
Love that. It's powerful. We have a question here from Dado. According to the people you've interviewed, what is an acceptable maximum drawdown?
Well, maximum drawdown. Well, that, I don't know. It's usually moderate. I don't think most people I've interviewed would have ever been comfortable with anything over 20%. Mm-hmm. And I think for the most part, really would have wanted to keep it to single digits. And the focus is more on the risk of an individual trades, because if you limit the loss of individual trades very severely, then you'll keep the overall drawdown from being very large. If you also marry it with the idea that when it's not going right, you just don't keep on digging a hole deeper. So it's not so much that people said, I'm going to limit my maximum loss to this. It's more a matter of they're saying, I'm going to limit my maximum loss per trade to this. And if I start losing, I'm going to, it's not going right, and I don't feel I'm in tune, I'm going to stop trading. It's more those things than picking a maximum drawdown amount. But I would say, generally speaking, you really want to avoid ever getting beyond, maximum of 20%. And if you can keep it to single digits, even better. Now, of course, that means you make money slower because you got to keep your risks down. But the key about trading is you don't want to get knocked out of the game. There'll always be opportunities. The markets are always changing. They're always there. You just want to make sure you don't let a few mistakes cause so much damage that they knock you out of the game.
Yeah. And I think this is going to lead us to Fundseeder, because what I've seen for myself is that investors look at drawdown a very different way than traders. Like we might think that 25% is fine, but for an investor that might be like way too high, right?
Yeah,
So just tell people what Fundseeder is about and how you came to start co-founding that company.
sure. For Fundseeder, the idea behind Fundseeder, and I won't take credit for it. It was founded by three people, which I'm one of, but the primary founder was Emmanuel Bellari, and it was really his idea. He pitched it to me. He was with he had a subsidiary with a brokerage firm, and I was an advisor to a fund, multi-manager fund, and that was our connection with that brokerage firm. But he had this idea of founding this financial technology company, which called Fundseeder. And the idea was this: why not create a central hub on the web that traders could connect to, and, traders globally, and people who have trading skill, and might want to manage money, but just don't have the connections, or they're in countries where there's no well-established financial community, which is most countries other than the highly developed countries, and wanted to have the opportunity to maybe have a career in asset management, but didn't have the pathway. And that's true, really, of most people. And have a way of connecting them on the web via investors who are looking for new trading talent. But how's an investor going to find? You have some. I'm thinking of some of the traders that we found on Fundseeder, and but they're in places like the Czech Republic or something like that. And I'm picking this one particular because I think it's one trader, kind of really a phenomenal performance, completely differentiated approach, and basically I think his last job was like a bellhop or something,
Wow.
but sort of taught himself trading, came up with this methodology based on earnings and stuff, and it's just done enormously well over 8-9 years with just very steady returns, and way better than most hedge fund managers. But of course, just managing his own money, but in highly liquid stocks. So somebody like that would have no higher education, no like I say, a country like the Czech Republic, there's no real financial. So somebody like that would have no chance in the world of ever managing assets. Yet on Fundseeder, our thing there has been a few things. One, we have our own analytics, and our analytics are based on daily data. So that makes it more powerful than typical analytics used in the fund management business. People use monthly data. Well, monthly data is okay, but daily data tells you a hell of a lot more. So you can have somebody who shows a positive month. You might not see they had a 20% drawdown intra-month and just managed to come back, but that drawdown is hidden because the month falls in such a way that, maybe they'll have a small loss at the end of the month, but it's hidden. But in daily data, there's no place to hide. So when you get, and my bias has always been, I only pay attention to return to risk, not return. And so when you get somebody who has really solid return risk based on daily data, that's really a lot. That's very meaningful, much more meaningful than having good stats on monthly data. So one is that, plus another thing is that our site links to brokers, so we're not getting the data. We're not getting the data from the individual. We're getting the data from the brokerage firm, right? So, and I mean, there are brokers that don't link, in which case individuals can upload the data, and then of course we would have to, we would be verifying the data one way or the other. But to start out with, most of these accounts are linked accounts, and so when I see somebody has really good results, return risk, I know it's basically the data's first coming from the broker, and also it's based on daily data. So you can have conviction in somebody that normally wouldn't have the resume that looks like anything, right? They're not a Princeton graduate with a major in physics and work for some well-known hedge fund and starting their own business. It's not that type. Now you may get that, and we do get that, but you also get you get, I mean, we've had people sign up from over 100 countries. So you really do really get a global representation. And in fact, when I mentioned to you earlier, before we got started officially, we have this accelerated program where people can apply and they go through a process. And most of the people that have been gone through to the interview stage and all that have actually, the vast majority have been not inside the U.S. They've been people from different countries, not the U.S. So it's kind of interesting that there is all this global talent out there. So we provide this we provide the site for traders. They can link their accounts, they get the free analytics, and what we're interested in is not having the traders pay a subscription to get the analytics. We're just interested in finding them, and when we find them, we can then use them. We can then link them up with investors through the sister company, which is Fundseeder Investments, and Fundseeder Investments will sign agreements with those traders that really look good. And we're in a process. This is the year where we're moving just from the Fundseeder technology side to the investment side, because this is the year where we're actually begun the process of planning to do a multi-manager fund, and also picking traders and signing agreements with them to represent them, where we have a bunch of investors who are interested in finding the trading talent. So this is the year where we are looking to begin to shift towards the monetization and to having the kind of combining with Fundseeder Investments using the data of Fundseeder technology to allocate assets. And so anyway, that's kind of a long answer. So what Fundseeder is, it's a way of bringing investors and traders of new talent, trading talent together.
And this is really shortcutting a lot of the process of finding investors. Like I've personally, for myself, when I started to trade for other people, it took me a long time to like find the people, talk with them, show them everything I had to show them to be able to trade for them, then being able to trade and showing them the stats. While like Fundseeder does all the work, which is pretty interesting.
And it would be impossible, like I say.
Yeah.
And when I was on the hedge fund advisory side, right, you get all these emails. You get an email, people, I make, X% a month or whatever, and you basically, you just ignore all that because you have no way of verifying it. And most of these things are just not true anyway. But the beauty of Fundseeder is that it's a quantitative, very well-defined approach to this thing. So you don't have to find the traders; they find you. But you're getting found by real traders, not people who are trying to pull a fast one or whatever, because the numbers are basically verified.
Love that. And that being said, do you have any insights on like what would be the proper risk to reward thing to look for? So we talked about the fact that we can have a maximum drawdown of like a few percent, but as like you said, you look at what we gain in reward as opposed to the risk. Any advice on like what would be an appropriate number for that? That ratio?
Sure. Well, first of all, I mean, most people use the Sharpe ratio. I'm not a fan of the Sharpe ratio for a number of reasons. The most important reason is that the Sharpe ratio does not distinguish between upside volatility and downside volatility. And while I've met lots of traders who get upset with a 10% monthly loss, I've never in my life yet met a trader who's upset by a 10% monthly gain. So the Sharpe ratio, in a sense, really doesn't reflect what people think of as risk. It's popular, because it's popular, it becomes self-fulfilling, but it's popular because it's easy to use. It works well in the mathematics. You can make all sorts of, you can use all sorts of statistical measures, and you can use normal distribution, and it's very convenient from a mathematical sense. So that's one reason why it's popular, and it also is roughly representative. But the big problem is it does not distinguish between upside and downside volatility. So I prefer measures that do distinguish, and the Sortino ratio, which uses negative months as opposed to all months in terms of defining risk, is a better measure. It needs an adjustment which people can get. I won't go into. It's a big tangent, but as far as I'm concerned, everybody calculates the Sortino ratio incorrectly. It should, the way people normally calculate, it should be divided by the square root of 2. Otherwise, you have an automatic bias for the Sortino to be too high. But I'm not going to go into that tangent. It's on, the explanation is on the website. There's a link to the performance explanations. But the Sortino type of measure is one. My own favorite measure. We also have a measure, a proprietary measure on Fundseeder called the Fundseeder score, which is a very sophisticated and complicated measure, and I can't even begin to explain it. But that is actually a very good measure, and it's also less correlated to other return risk measures than anything else, and it is a good measure, and we use it to pick the managers that go into our index, and we pick the managers at the end of every month, and those are the managers whose performance affect the index in the following month. So it's set up in a no hindsight fashion, and so it's run in real time for over 2 years, and it's worked extremely well in picking traders who continue to do well. So that's maybe the best measure out there, but like I say, I can't explain it. And even if I could explain it, well, it takes pages and pages of math to explain it all, but it's proprietary anyway. So it's a return risk measure. It uses lots of different inputs, stuff like track record length for reliability, and the shape of the distribution curve, and trying to discern patterns that are indicative of high tail risk traders to differentiate them, things like that. But so the Fundseeder score is a very good measure. Now, for something that people can understand more easily, my favorite measure is the gain to pain ratio, and the gain to pain ratio is a very simple measure but very effective, particularly if used on daily data. And all you do basically is you take all the daily returns from the whole track record and you sum them. And then you take all the daily losses only and you sum them. And you take the ratio of all the returns to the sum of all the losses, the absolute value of those. And that's the gain to pain ratio. And on daily data, basically any number above 0.15 is okay, above 0.2 is good, and above 0.3 is extremely good, and up from there. So that is a very, very good measure because it counts every single loss and it weights the impact of every single loss by its size. So I find that as a quick, easy tool and very easy to understand. It's basically how much gain you made relative to how much loss you incurred during that time frame to get that gain. And of course, it's very different for daily data than monthly data because you can have all positive months and still have lots of daily losses. So the daily number will be roughly 7 times, factor of 7 lower than the monthly number. It varies, but that's a rule of thumb. Mm-hmm. So anyway, the gain to pain ratio using daily data, and if you can get above 0.2, 0.25, you're doing extremely well.
Love it. And those are very simple calculation, I think, the last one you mentioned. We have Alejandro who said he likes the Sortino ratio more for the fact that, as he said, it works better because it doesn't count the up and the down as well. So that's interesting.
Right.
Okay. Yeah, go ahead.
Sortino ratio, the Sortino and gain to pain ratio will have a significant amount of correlation between the two of them. They do kind of similar things.
Mm-hmm. If we could look at this on a kind of bigger scale and a general overview, one of the questions I get a lot is like, what do I need to be able to trade for other people, trade for investors? So if we're to go to look at everything needed, what would be the type of like track record we need, and what would we need to be attractive to investors, in your opinion?
Okay, the investors look at lots of different things, and for most of the established investment world, lives in a check the boxes arena, so to speak. So a lot of good traders may never get anywhere because people have a check the box. are you managing at least $50 million? If you're not, they don't want to look at you, right? Or 100 or whatever. And so that's one type of world. And no matter what you do, unless you're already established, you're not going to get those assets, which are a big part of the investment world. But but like say, like somebody like Fundseeder, we're not using that type of criteria. We're trying to find people who can trade, and maybe they've traded much lower. Now we're not going to be looking at accounts like a $10,000 account. That's not going to tell us anything. But we're certainly willing to look at a $100,000 account, things like that. If it's liquid and if it could be scaled up as somebody who potentially could be managing more assets. But now what you need to do is you performance-wise, you need to have good return to risk. Not just a matter of return. You can have high returns, but if your volatility is crazy, then that's going to be a big negative impact. You need to have a risk management plan that you can explain, that is well defined. You need to have a methodology that you can explain, that is well defined. You need to have, it's helpful if you have an approach that's differentiated. And the tricky thing here is you have to be able to explain what you do without giving away trade secrets, okay? So legitimate allocators for the most part, they're not looking to find, your trade secrets, right? They're just trying to understand what you're doing. So, and there is a line. I mean, I think almost whatever your approach is, you could probably explain without giving away the trade secrets. But you have to be willing to at least explain what you do and be able to explain what you do and what your method is. So those are key things, being able to define your methodology clearly, being able to define your risk management clearly, having good return risk. Those are all, I think, important elements.
Mm-hmm, mm-hmm. And what about people who live in like certain kind of low-cost country or low-income country? Would it be disadvantaged by the fact that you need some certain account to show your performance, or?
Rephrase that.
So people living in, let's say, low-cost country that they need to have an account of, let's say, $100,000 trade.
Yeah.
Would they be kind of disadvantaged because it would be hard for them to find that money?
Sure. I mean, in a typical world, yeah. I mean, if you're managing anything, even under 10 million, it's very difficult to find allocators. So the established investment world really focuses. The money goes to those who are already managing money. That's just the way it is, and that was one of the primary reasons we founded Fundseeder, really to democratize and globalize the whole asset management process. So if we're successful, we're looking to disrupt that normal way where all the money just goes to the giant hedge funds. And the idea, if we want to show that you could find 100 great traders who are all over the globe, and you put them in a fund and have smaller allocations and have a product that's actually return risk much better than the big name hedge funds. Mm-hmm. And so that's our whole premise. And so now we're not saying we're the only ones that will allocate to smaller traders, but it's hard to find investors who are willing to look there and go there.
Yeah, definitely. And it also works in terms of like relationship and stuff in the investing world. So if you have no relationship, if you start from just yourself, it might be hard to go and find people to trade for.
Exactly. Relationships are a big deal, and you're not going to have it for most people throughout the globe. They're not going to have those relationships. It's going to be, and they're not going to have the Ivy League colleges. They're just not going to have the things that typically people who are allocating larger sums of money are looking to allocate to.
Mm-hmm. We have a question here from Naib who asked, what type of track record do you need to be able to get capital? He's been trading for 5 months profitably with a 5% monthly return. Would that work, or would that have anything more to show? What would we need to kind of work on?
5 months is just really, really short. Now, in daily data, you kind of get some information more quickly, and it depends on the methodology. If the methodology is one of shorter term trading, and then a shorter track record becomes more amenable. But I would say really kind of a minimum of 12 to 18 months. I mean, if you've got spectacularly consistent returns over 12 to 18 months, that could begin to at least, get some exploration, say on our part, ideally at least 2 years, but I'd say between 1 and 2 years is possible, depending on how consistent the returns are, on what the trading methodology is, and things like that. But anything under a year that's just too heavy a lift.
Mm-hmm. Yeah, because I think for myself, you can have like a few great months, and then you can end up with a few bad months in your year, and then your kind of year view is
right.
completely
So
different.
and you can't go faster in real time, unfortunately. And
Yeah.
The reality is you should figure probably 2 years plus before it starts looking. But under certain circumstances, 1 to 2 years, can show up.
Mm-hmm. Yeah, I totally get your point. Kind of depends on the situation and stuff, which is normal. We had a question here about the process. How does the process work? Once you want to be able to trade for other people, do you create a Fundseeder account, and then what happens next?
Oh, sure, thanks. So very simple. You go to fundseeder.com and you link you go to link to your account. It's very easy to do. I mean, it'll be just some drop downs. And let's take the easier assumption, say you have an account with a broker that does link. You'll just click through a couple of choices, like the broker, I think what your asset size is, a couple of things you indicate. And at the end of the process, you'll get a confirmation, and you'll then get an email that'll have, depending on which broker you're using, it'll have like a ready-made email that you can then forward to your broker, and it'll probably have who you forward it to, and it'll basically be authorization to link your account with Fundseeder. And then once your account gets, the broker links it, you'll get a message saying your account is now linked and your account will be on there. And then the beauty of that is that it updates daily. You don't have to do anything anymore. And your account will update daily, and it's all done. So that's when, if you're using a broker that's in the list of linked brokers, if you have a broker that's not currently linked, and again, in these cases, it's not so much our choice. It's certain brokers have cooperated, certain don't. But in any case, if your broker is not linked, then what we have is the option to create an unverified account. And an unverified account, basically, you'll download an Excel template, a daily template. And what you have to do is essentially copy and paste, use a spreadsheet where you have indicated your daily returns, copy and paste it into our template, upload it, and boom, it's done. The only thing there is you'll have to manually upload it. You'll have to manually update your data as often as you want, and your account will show up as unverified. Now, we still look at unverified accounts because we understand that for the most part, in almost all cases, people are choosing that route because their broker is not linked. So it's not. Now, if you get an unverified account that's with a broker that's linked, it doesn't really make any sense, But in those cases, that's what your option is. You just upload it, and then if we found the trader that's interested in that route, well, like I said, we always have to still do the due diligence anyway. My assumption is if anybody's uploading data, it's not going to do them any good to upload false data because it'll come out. We'll find it anyway, and it'll just kick off the site and whatever. So it won't serve any purpose. My working assumption is it's probably correct even if it's unverified. But it's a very simple process. Either way, it's a simple process to get your account up.
Nice, love it. And then what happens next? So do you just like trade and everything's going to be taken care of?
Just trade. First of all, you have your own. So the site will do. First of all, it's really neat because, like, I don't know anybody else. You can see a curve of your daily equity, right? So, and you may need to. By the way, for some brokers will import the past data, some don't. So you may need to use the template to just backfill your data, so you have all your history of your data. In which case, in Fundseeder, will be a hybrid, unverified, verified in that type of case, and you can look at it for the whole period, or you can look at it just for the verified portion. But the bottom line is you can get your whole track record up there. So what you'll get is, for one thing, you get an equity curve. Okay, besides all the stats, you get you get a lot of visual information by being able to look at your equity curve. You'll be able to get tools like, you'll be able to do stuff like apply technical analysis to your equity curve. So might say, well, what if I stopped trading every time I had a drawdown of 5%, and then paper traded, and when I was rebounded to 3%, I started trading again. What would my equity curve look like if I did that type of technical approach? Well, we've got tools in there where you can it'll do a quick simulation of what a risk management like that would do to your equity curve. Well, what if I wanted to do a 10-15 crossover moving average applied to my equity curve? What would it have looked like? And it'll show you the equity curve compared to your actual equity curve and the stats for each way. So you get a lot of free analytics and stuff. So that's kind of there, whether you end up managing money or not. Now, once you're on a site, you're eligible. You can end up on the leaderboard, and which is the best traders based on the FS score. And if you're in the top 5%, you actually get put into the index. So I mentioned we're looking to do a fund based on our index. Well, you basically would automatically qualify if you get chosen for the index. You would automatically be qualified for that for that fund after some due diligence. So you wouldn't have to do anything. But bottom line, if we're interested in you, either because you're in the index or because your numbers are showing up as really strong, then we would sign an agreement, a fee sharing agreement, and then our investment side, Fundseeder Investments, would basically, if they have traders that are interested in somebody with your record and type of trading you're doing, would connect you, or you might be picked for a multi-manager fund. So once you're on the site, you become then eligible to be selected for asset, on the asset side.
Mm-hmm. Love it. That's very interesting. And I love how simple it is and how all the stats you get. That's pretty awesome too. If I can tweak and adapt and see what that looks like. Wonderful. What a question here, I think, from Naib. This is about, so if you have a small account of less than $10,000, would it be worth it to sign up for Fundseeder?
It would be, we kind of let anybody come on. Now, I'm going to be honest, we don't really, we won't pay attention to any account that's really, in terms of considering an account for asset management, our kind of cutoff level is 50,000, which is still extraordinarily low in the industry. Yeah. But but that's what it is. So if you could have a $10,000 account, we're really not going to pay attention to it, for the reason that that's just too small to be representative of anything, and you can't diversify that type of account, and your trades are going to have very large impacts. And we find also accounts that small, the numbers are just crazy. They'll swing all over the place because the base is so small. So now you could still use the analytics. You could still get your equity curve. So you get free use of it whether your account is small or not. So we're okay with you linking up, but realistically, will we look for traders that are that small? No, we won't look for traders unless they're at least above 50,000.
Mm-hmm, mm-hmm. Which I think we had in the chat. I think Alex found a great solution. So what about if you're good to trade, you could try to get money from people around you, so friends and family, for example. And from then, if you have enough capital, maybe you go on Fundseeder and start to...
you can. And also, I should say that one of the things we do, which I don't think anybody does, is when you sign up, you get a choice. Do you want to base your performance numbers on the equity in the account, or are you just using margin? Are you kind of like a margin trader? You want to define the nominal account size. So if I'm a currency trader, let's say, I may only need to put up 1% margin, and for efficiency's sake, conceivably I could have, let's say, a $20,000 account but I'm trading it like, it has a little of wave volatility because I'm just putting money in when I need to add assets for margin, but I'm just basically utilizing most of my cash. Now, if I was going to have investors allocate to that type of account, it wouldn't be a $20,000 account. That might be, let's say, a $200,000 account. So you do have the option of defining. You go in and you say, is it a net liquidating value account or a nominal account size? You could say if you're a highly margin trader like futures or FX, you could say it's a nominal account size. So you might now, if a trader like that has 20,000, but he's trading at like 200, we'll still look at it as like it's 200 because that's what they've defined. Now, what that'll do is that'll cut your returns by a factor of 10 relative to the money in the account, but it'll cut your volatility by a factor of 10. But more importantly, it's representative of what the trading level is, because for highly leveraged accounts, if somebody is just moving money in and out and trying to be highly efficient on the use of margin money, then the account size is not representative of what the account would be for an investor. And so they do have the option to define their account as larger.
Mm-hmm. Kind of a technical question here. This is Alejandro. What if you have an account for yourself, like say 25,000, and then you manage for 200 people in two different accounts? Are you able to kind of have different account to your name and consider this to be your whole capital?
Oh yeah. So the idea, if you have multiple accounts,
Yeah, sort of.
Yeah. So it would still be, each account would still be on its own, and the fact you have multiple accounts would show you're managing a large amount of money. But bottom line is, sort of in terms of where we're searching, for traders. And in fact, even the FS score is itself set up so it will exclude equities under 50. It won't even look for accounts under 50,000. So the account is pretty much set up. The structure of not the account, the website set up to focus basically on accounts greater than 50, although it accommodates accounts of all sizes.
Mm-hmm, mm-hmm. Interesting. Awesome. A question from Alex here. Are most institutions looking for individuals who can day trade or swing trade, or does that make no difference?
Yeah, it doesn't make any difference to us.
Uh-huh.
So it'll accommodate traders. Of course, the daily numbers will be based on the closing prices, but the intraday, the trades will be captured in terms of trade stats, but basically the site will work whether you're a day trader or an intraday trader.
Mm-hmm,
doesn't make a difference.
And have you seen a great percentages of, let's say, day traders compared to swing traders, or is it pretty much the same?
It depends. It's frankly, I think it's extremely hard to be a day trader and be profitable because slippage becomes such a large percentage of each trade. So I think it's very difficult to do. But if you've come up with some incredible methodology that is a day trading that can overcome the slippage factor, then great. That's even better, because the risk, by being a day trader, you're avoiding all the overnight risk. I'm just saying it's very hard to do. But if you've got a day trading approach that actually can make money, that's even better.
Mm-hmm.
I wouldn't. If people were looking to develop approaches, I would steer them away from day trading approaches because they tend to be extremely difficult to pull off successfully, because slippage is such a large percentage of each trade.
Mm-hmm. Any difference as to wait, I had a good question here. Sorry about that. A blank. Let's see. I just want to see the comments, see what we have. And if you have any question, comment in the chat. We'll make sure to answer them as always. So do you trade accounts from, let's say, Forex trader and stock trader the same, or are they different a little bit?
Yeah, we basically, traders will self-categorize them into what instruments they're trading, which could be multiple. They could be trading equities and futures and FX, but they'll check off the boxes of which. So we will have categorizations, but the analytics are the same. So the same analytics get applied to everybody. We are able to filter results because we can have an investor saying, I'm interested in finding a futures trader that has a track record of at least so many years, that has a maximum drawdown of that. So we can filter out those things, but As far as the analytics go, they're the same analytics whether you're trading equity or whether you're trading futures or whatever. Of course, if it's an equity trader, the benchmark would be different than it would be if you're a futures trader.
Okay, interesting. So pretty much the same, except that people are gonna have different account. That's good.
Yeah, I mean, just it would be the same. We're able to categorize traders, but the analytics are not different.
I'm curious to hear a little bit about the Extractor program you have on Fundseeder. What is that about, and how can people apply it if they want to find out how that works?
Okay, so the accelerated program, basically, you just apply to it. It was originally the idea was to just do it at one time, and then pick traders and do just have it a one time deal. But we found that there was enough interest, and ultimately there was no reason to cut it off. So we left it open. In the sense, people go on Fundseeder, and it should be on the website, the accelerated program, or you can search for Fundseeder Accelerator, and you basically would send in an application. There'll be questions you'll answer, like describe your trading methodology. It'll have there'll be an application which will give us a lot of basic information. Then we will review that information, and based on that information, make a decision whether we feel the trader should go to an interview stage or not. And if not, you'll get a notice saying that it wasn't a fit, whatever. You can try again in the future, whatever. If it get to the interview stage, there will be an interview, and then after that interview, traders are sorted. Either they might get rejected after the interview, they might get accepted, which means the next step would be some sort of signing a representation agreement with Fundseeder, or they might be in an in-between category where, we don't feel quite ready to trade it. We don't feel ready to sign an agreement yet, but the trader is potentially interesting, and we're going to put it on an active monitor list. And then you get into a net monitor stage, and that's a separate classification, and those traders get closer scrutiny. So that's the process, and you will know over time where you fall. Like, let's say you go past the interview. After that interview, you'll be told whether you're accepted, or whether you're or rejected, or into the monitoring category. Now, once you're accepted, there may be additional steps. Like, if we feel some traders, we may feel like, we feel you're a right fit, that we can find investors who are interested, but your presentation is a bit sloppy, needs a little bit of work. We might work with you to kind of refine the presentation. Also, one of our plans is to have a virtual summit where we pick like 20 or 30 really top traders that have gone through this process, the accelerated program, and we showcase them in a virtual summit that are open to invited investors. And then we would work with our traders to hone a 10-minute video presentation for that summit. So we work again with them. So that's kind of the process. It's an ongoing process. And if you go through the point where you're accepted, then there might be some additional steps as well. But that's the process. It all begins with the application. Yeah. So you got to do the application to be considered.
Interesting. And I kind of like the formality of it and all the steps that people have to go to. Because I think people still have to put some work, and that's always important. Even if they want to be full-time traders and everything. So it's great. Yeah. How can people find you if they want to connect with you or reach out?
Basically, through Fundseeder website, or my Fundseeder email, jschwager@fundseeder.com. They want to directly email. But basically, these just going on Fundseeder will have all the information.
Wonderful. And just if you have any other question, I want to finish with maybe one last or two question. Let's see. Wonderful. Cool. Yeah, that's great. Question here from Anmal. When do we know when a strategy is broken? Any thoughts on that?
Like for a systematic trader?
I guess so. Yeah.
Yeah. That's just a almost impossibly hard question to answer. Almost all systems will have drawdowns, and a lot of systems will have drawdowns and continue working. But there are certainly cases where systems have a drawdown and it just keeps on going. And I don't really know of a good way to differentiate between the two. What most people basically do is when they're systematic traders to define a maximum drawdown they're willing to accept, and if that point is hit, to consider the system broken and just stop trading. Now, it is helpful if people have multiple systems, and therefore they not all their eggs are in one basket, and then they can set exit points on each system, or even maybe not even need to, because there's enough diversification that no single system will cause damage. So the optimal answer is that if you can develop enough systems that are differentiated, that can get around the problem. But if you're trading a single system, I don't really have a good answer of how you can know when something is stopped working to versus when it's just having a normal drawdown. I mean, part of it is certainly if it goes outside of historical bounds, that's not a guarantee that it stopped working, but that's certainly a danger sign. You can also sometimes see it in just that it's working differently. So, like I've had traders who have a system that they will make decisions on one market based upon how another market, and they can see that the behavior, or based on time of day, but they can see that it's just no longer working, and they stop trading. So one thing you can do is, if you're getting if your system is short-term, getting short-term signals, and you see you're getting too many trades that are just not working, then you can think that, well, maybe it's out of phase, it's not working now, and you can continue monitoring it and begin trading when it starts looking like it's working again. So that's another thing you can do is if it's a shorter term trade, when you're getting too many trades where it's not doing what it's supposed to be doing, then stop trading it and wait till it starts behaving like it's supposed to behave.
Mm-hmm. I think those are great pointers. So Jack Schwager, thank you so much for being here tonight. I really appreciate it. I think people love it. And if you guys have any questions, comment below in the comment section. We'll make sure to monitor those and answer after the event. Give a like if you enjoyed the video today, and we'll catch you guys pretty soon. Ciao.
Okay. All right.